A while. Well, our next guest is also bullish on gold. Aaron Smith is Managing Director at Superfund Financial, based in Singapore. Superfund's euro-denominated fund is the fifth best performer among managed futures funds. It's up 60% in the past year. Superfund employs a computer-driven technical trading system for absolute returns. The model commonly called a quant fund. The company invests in 100 different markets: commodities, stocks, bonds and currencies. And the question is, what happens next? Aaron, very good day. Thanks for joining us today.
Good morning, Paul.
Let's talk about commodities first of all, and in particular gold. Obviously, as has been stated so many times in this program, beyond jewelry, it has very little actual purpose in this world. It is simply seen as a hedge against currency depreciation. It's treated as the kind of currency you can't fake or print at a moment's notice, as governments do with paper currency. So what do you think about gold?
Well, Paul, I tend to disagree with your view that it's not useful. Gold actually is the only real currency in the world. Gold is money. If you look at all the paper currencies in the world today, they're flawed by the fact that they're not actually based on any real underlying value. Since 1971, when the U.S. dollar went off the gold standard, central banks have been able to print paper. And I think that that's one of the reasons why in the next 2 to 3 years, inflation can come back onto the table as a major theme, which will impact markets going forward. So we think gold certainly is an excellent alternative to holding cash right now. If you hold cash with these interest rates, you're making a negative return after inflation, whereas gold has kept up with inflation, not only just in the past 8 years, but over the past 2,000 years.
Okay, I should clarify what I'm saying, by the way. Gold has no practical use in the sense that it's not an asset that you can burn for energy or build your house with. You could build your house with gold, but not strongly recommended. It is treated, as I know, as a currency. There are plenty of people out there, including currency analysts, who say everything you say is true. The problem is that too many retail investors and hedge fund managers have come in with that point of view, and therefore they bid gold up beyond the level at which it should really be priced. Do you disagree with that, clearly?
I do disagree with that. I think gold can go much, much higher. In dollar terms, we think that gold can go to $1,500 per ounce, certainly in the next 2 to 3 years. Much of that will be based on erosion of the value of dollars because of the increasing money supply. The Federal Reserve and the Treasury seems to be bent on increasing the money supply, although since March 2006 we don't have any M3 data. That was a precondition of Bernanke taking office as Fed chairman. However, we do know that the money supply is increasing dramatically, and that's a major concern. So a lot of people look at equities, for example, that went up from 2003 to 2007. And nominally, that's true, but if you look in real terms in price relative to gold, equities actually were in a clear downtrend since March 2000.
Okay. What are your, let's stick with commodities for the moment. What are your computer models telling you about commodities as an asset class, rather than just the precious metals, the coal, the oil, the soft commodities, the copper and so on? Is money going into there? Have these got momentum?
Well, in the past couple months, we've profited from short positions in live cattle that we've closed out. We've given back some profits that we've made in crude oil, for example, where we were short for the fourth quarter of last year and for the beginning of this year. Certainly, there's been a reversal in crude oil. So right now we're more or less, the models are more or less ambivalent about commodities, and we're looking for clear trends to develop. So once there are clear technical trends, then we'll start to take positions in commodities. We certainly think that commodities will perform better than equities if you have a long-only view in the next few years, because they have a real underlying value, which you can't really say about any paper asset in the world today.
Let me just sort of narrow that down, purely when you look at oil, because the issue with oil is that it keeps going up at the moment. I mean, it's obviously way off its highs of last year, but yeah, we've got massive inventory overhang at the moment, the highest in decades. Demand is clearly, even if it's stabilized, it's well down compared to historical average, but oil prices keep going up. That suggests there may be a correction around the corner.
Yeah, and that's exactly why we're not in that trade at the moment, and we're waiting for a clear uptrend to develop. We're content to miss the bottom, and we're not trying to pick the bottom of the market. We're waiting for a clear technical trend to develop, and I think it's probably too early to say that we're in a bull market phase for crude oil. at this point from a technical standpoint. However, going out for the next couple of years, we certainly expect that oil will get more expensive as compared to equities.
Okay, Aaron, stay in your chair. When we come back, we're going to take a little bit more, a closer look at equities, via index futures and the trends you're seeing there at the moment. Also, of course, foreign exchange as well, and a little bit about the performance of Superfund so far. You're watching the Bloomberg Edge. If you want to send us emails, please do so. asiaedge@bloomberg.net. Also, the pharma sector is riding on a mergers and acquisitions wave right now. Josie Lewing looks at the potential winners in today's installment chart of the day. We're not talking about the big pharma companies. We're going down the list, see who else benefits. And as ever, anything else you want to ask us, asiaedge@bloomberg.net. Send them in. Back in 2.